Good afternoon Futex traders, and welcome to this edition of our FX and commodity rundown. So very briefly, what we're going to have a look at today is we're going to start off with just a few fundamentals, and we're going to look at the fundamentals specifically to the US dollar, the oil and the gold markets. We're then going to move on and we're going to just briefly discuss the dollar index and where it is at the moment and the trend and all that. We're then going to move on to what I would deem my highlight of the day, or my highlight subject matter of the day, which is effectively the Japanese yen. I'm going to show you something very interesting, a very interesting trade idea, and I'm going to show you a few little things that you can use to almost take part in this trade and make some money. We're then going to move on to the pound against the dollar and have a look how it's responded post-election, and then we're going to just finish off by looking at the euro against the dollar and again revisit the Canadian dollar. So let's get into the fundamentals. First thing I want to talk about is oil. So first things first, we saw late on Thursday afternoon the FT producer report talking about how a few of the Saudi Arabian some of the oil big boys are talking about how oil's almost reached a bottom now, and we're never going to really see those levels again, and that the strategy that the Saudi Arabians had used by not allowing to reduce production has actually paid off, and they're starting to get more market share. So there was a very interesting article about that. Now, the reason I'm pointing out is because when we have a look at the oil price, I actually want people just to get a feel for what oil's doing and how oil's been responding over the last couple of weeks. The second fundamental I want to draw people's attention to is the EIA crude oil inventory data. Again, just like last week, we saw the second drawdown in a row. Just to point out, I did say this last week, but we were expecting last week a build in the oil inventories, quite a strong build, and we actually had quite a big drawdown. And the reaction in the oil was particularly interesting. The market, the price of the oil actually initially blipped up, as it should have done, very aggressively, and then got hit straight into a really big seller, stepped into the market and sold it off very, very aggressively, and we posted a very, very bearish technical play. Now, at FutexLive, we believe when a market responds off a fundamental the opposite way to what it should, that's a very strong technical indication of what's to come in the future. So what I'm going to do is very briefly is we're going to get the oil chart up and have a look at where this market is going. So if we take a look at the oil, just bear with me 1 second. Okay, so yeah, we have the oil chart. Now, what I want to point out, just a few little things, was if we go onto a daily candle, alright, this candle that we have here, so if we look at this very, very strong rejection candle, that was the day that fundamentally, the fundamentals were telling us this market should have aggressively gone higher. Yet it actually did the complete opposite. So that was last week, and then yesterday obviously we had again the data came out more or less as expected, and again price opened, tried to move higher but actually closed lower. So again, twice in a row the fundamentals are suggesting oil should be moving higher based on supply and demand. Yet actually we're starting to see price move a little bit lower. Now, very fascinating, and what I want to point out on this chart, and it's something that all traders should look at, is something FutexLive and Dan Goldberg particularly look at quite often, and he talks about it a lot in his profiling. But when a market effectively, if you look since January, the market sort of stabilized and sort of between 42 and 52 started to accept a bit of value in the market. It then broke above this area and aggressively moved, or not aggressively, but rotated even higher, leaving what we call like a volume void, or an area of low traded activity. Now, very important in a trending market that we have in this oil, if you look at the trend in the oil, okay, when you have a very strong trend in a market, it's very unusual for it to leave a low volume area like this in with the trend. In other words, had this been to the other side, in other words, as we were coming down, it's very likely that we leave low volume areas. But because the trend's to the downside, what we'd be looking for is we'd be looking over the course of the next days and week for oil to start to drift down and effectively come and trade this area out and almost turn this area into a very accepted area of price. So don't be surprised with the weeks ahead you actually find that $54 a barrel starts trading on a daily basis. So in terms of strategy for next week, what I do want to point out, there's a great opportunity to trade this market. We have got an inside week. as you can see. So last week was an aggressive sort of flat close doji. This week again, inside week, again going to close doji. What I'd typically be looking for, the break of this week's low, I'd be looking to initiate shorts, and I'd be looking for a target of that 54.20 area. So that's the oil. Very interesting chart both fundamentally and technically, and is definitely showing some great opportunities to make some money. Let's then move on to the next fundamental, which is the US dollar. So very briefly, what I want to talk about in terms of the dollar is what we've seen over the course of the last 2 weeks is, well, over the last couple of months, is very, very weak data. Now, I just want to bring up the retail sales chart so people can get a feel for you know, this is what we received on Wednesday out of the US. Again, another very weak retail sales number from the US, and it's showing some weird signs. You know, the market almost for a long time has been very dovish and hasn't really believed in the recovery of the US, and we're still seeing this weak data. Even though the Fed's telling us it's transitory, we still continue to see this weak data. So that was the first piece of data I wanted to show. And the next one was the NFP data. Now, I know the NFP came out as expected mostly, but very important is we're still very much below this purple line, which is the 12-month moving average. Now, on average of the last 12 months, we've been doing about 250,000 jobs a month. And again, we still, you know, we've seen a few, you know, it's two relatively weak prints over the last, 2 months. Now, the reason I'm pointing that out is because if we look at the structure of the dollar index, you will find that effectively we're in a very strong uptrend, and we have been in this very strong uptrend for some time now. But over the last couple of weeks, we've continued to see this theme of not shorting of the US dollar, but profit taking of the US dollar. Now, whilst the data remains weak, I struggle to see how, you know, the dollar is going to become a very strong buy. You know, so long as the data remains weak, I don't think it's time to buy the dollar yet. You know, the minute we get one of those good strong prints where the data turns and it shows that the Fed is still, you know, going to push the hike button later on this year, by then all means I'd say, you know, pile in the dollar. We're going to get back to that area relatively easy and relatively quickly. But for now, I do favor a little bit more sell side action in this US dollar. I'm not convinced we've quite found an area where the buyers are going to step in yet. In terms of ratios, fib ratios, well, we're not quite at the 38.2% of the trend up. So again, I'd say this market, you know, I'd still be looking to sell dollars on a rally, not necessarily sell low, but sell on a rally. So keep an eye on that US dollar index, particularly interesting. The fundamentals at the moment are still relatively weak and are still sort of looking, are still showing that we could see some further sell side action in the US dollar. Let's then move on to the next fundamental, which is the gold. Now, I've listed this as the re-inflation trade. Now, a fascinating thought, and I've been looking at the charts and trying to get a feel for this gold. And if we take a look at gold, I think I'll show the chart first, and then we can discuss what I mean by this re-inflation trade. Now, if we look at gold over the course of the year, it opened the year sold off. Yeah, we had a very nice little sell-off early on the year. It then kind of recovered and bounced, but then since then, for almost a good month and a half, the market's gone sideways. Okay, it's been luring shorts in and then washing them out, and then luring longs in and then washing them out, and then getting people long, getting people short, and just washing out positions on both sides of the market. Now, the reason I like this chart and why I want, you know, traders to pay close attention is very simply we've got this area here of 1223, which is acting as a firm resistance point. It's a point where the market says thou shalt not pass here, and it's so important when you get these kind of areas, the day or the week that you get a strong close above it, okay, that could unlock not just volume but could unlock some trend in the market. So very important, keep an eye on this 1223 over the next weeks. It's providing good resistance now, good profit taking for the longs, but once we scale above that and the longs commit to higher prices and they're willing to hold higher, okay, we should very quickly see gold move up towards its upside target. If I just show you this trend channel of 1265, somewhere around here. So very important, guys. We're in a great little juncture zone. Your market in the medium term is still very much leaning toward the downside, but structurally this market looks like, you know, if it can get above this 1223, we should get back up to 1265 quite easily. So what did I mean by the re-inflation trade? Well, very simply, if I showed you again another very interesting chart, it's the gold with the 5-year. So on the bottom here we've got the European 5-year break-even inflation. Now what that effectively is it's the market's it's what the market believes inflation will be, in 5 years from now. Now there's been a lot of talk in the papers about this, the bond markets collapsing in Europe, and what's effectively driven this is this heightened or this rising inflation expectations in Europe. Now, very important, it's not just the chart that's driving that. There is a lot of fundamental data, whether it's GDP from this week, or whether it's the PMIs, or whether it's the inflation data, but things are starting to look a little bit more positive in Europe, and that's kind of why we've had these inflation expectations start to rise. If you couple that with what's happened in the US bond market, okay, we've seen a very strong 30 basis point rally over the course of the last 3-4 weeks. And as a result, we've seen that gold push from 1180s all the way up to sort of 1220, 1215, somewhere around there. So very, very important. It does seem as though the gold's starting to play a little bit of this reflation type trade, where as inflation starts to rise, people use the gold as a little bit of an inflation hedge. And obviously the other thing is we are seeing a little bit of a weaker dollar, so that's sort of contributing to this trend. So there's a lot of factors fundamentally and technically that are sort of pointing towards gold having potential upside move. To the downside, obviously, what I would say, okay, very important, today's low. I mean, if this inflation trade's going to work, we shouldn't really be getting back to below this 1210. If we do, well, it could be a lot more of the same, which is another downside move towards the 1180 support. So that's the gold. Good chart, fascinating, some good opportunities there. Keep an eye on it. Let's then move on to the Japanese yen, and what I would deem one of my favorite trades at the moment to keep an eye on. Now, the reason I'm pointing out in a lot of my streams, I kind of say to the guys, be careful trading a market that's not offering day trading opportunities. And what do I mean by that? Effectively, this is a weekly chart of the Japanese yen. Now, if we look at that, every technician will look at that and lick his lips and say, well, this is a wonderful flag. And yes, in essence, it is a flag. The market it's tightening up, and effectively it's preparing itself for potentially the next move higher. Now, fundamentally, the Bank of Japan is doing very aggressive quantitative easing, and the market is sort of leaning towards the Bank of Japan doing more quantitative easing, a bit like what they did when they increased their QE last year, October. So what I want to point out is that the market still believes that the Bank of Japan is going to do more QE. Now, we've heard from many Bank of Japan officials that right now they don't need more QE because the cost-benefit analysis doesn't make sense to them. It's not worth taking on that extra risk. And we've had Crude come out in the last couple of days and continues to reiterate this idea that they are going to reach their inflation target by the first quarter of 2016. So it's almost like Draghi, who was going on about how there was sufficient supply of bonds in the market. No one believed him, and all of a sudden one day we had this huge snap and the bonds collapsed. So a very similar situation. No one believes the Bank of Japan. However, I feel there is a potential catalyst. So in terms of technical structure, we've had now almost 8 or 9 weeks inside a very, very tight range. So this market is almost coiling on very low volume. So whichever way this breaks, in theory, should continue. So let me show you what I meant by in terms of what the potential catalyst could be. Now, this morning, very briefly, on the overnight news, we heard how there was a very panicked buyer in the JGBs, the Japanese 10-year yields, and they were talking about how it was the Bank of Japan and everyone was front-running them, and effectively the Bank of Japan just bought the highs. Now, what I want to point out to people is that what we've seen in terms of structure is the JGBs over the last since the beginning of the year have been stuck in this sort of 12-13 basis point range, a lot like European bonds. But if I take this pattern back and I take you back to the last time we had a very aggressive sell-off in the yen, okay, it's just the purple line here is obviously the Japanese yen again, or the US dollar against the yen, and the top line is the JGB yields. Now, the last time we had this sideways structure and the JGBs broke to the upside, we actually saw a little bit of a lag in the Japanese yen, and what we saw was the Japanese yen very, very aggressively, also this is the US dollar, so the US dollar very aggressively selling off against the Japanese yen. So what I would say, if anyone's trading this yen, please make sure you got the JGBs up, because they gave an early indicator the last time we saw a very strong rally in the yen market. So again, the structure looks very similar. Okay, the yen's been in a sideways for a long time. The JGBs are suddenly starting to rally. If this JGB takes out these 44 basis points, okay, from a pattern perspective, we could very quickly see the yen start to move higher against the US dollar. So keep an eye on that. It's one of these days. It's going to come out of nowhere. It's going to be aggressive. If you are short the Japanese yen, okay, very important. Just use that to your advantage. Use that information, and don't stand against it. You remember, the whole market is still short the yen against the dollar. So that's the Japanese yen. Let's then move on to the last three sections. The first one is the pound against the dollar. Now, I spoke about this last week, and I spoke about how the election result that we received was significant. It was really a positive for the UK economy. Now, I just want to go and have a look at what price is telling us in terms of pressure. And as you can see, we spoke last week and we said how, once we took out the top of this sort of trending channel, we should see a sort of a bit of more of a continuation or consolidatory type move. Now, we did reference this point of 55.5, saying that was crucial. If the market was going to turn around and all that, it would need to sort of hold that area. And very early on this week, we saw the market take that area, take up the stops, and continue to the upside. Now, what I'm going to say is that fundamentally and technically, this market is very bullish, guys. We've had almost 5 weeks in a row of continued upside movement. So don't be looking for shorts. Don't be a weak trader that goes and says, well, I want to short it simply because I can't get on the long. Okay, right now the trend is firmly to the upside. There's a lot of indications that are indicating potential further upside. So what I would say, if you are going to look for any kind of shorts, just make sure you're looking more at the extreme kind of points. The points where the market's almost exhausted and got a little bit ahead of itself. And those points, we've got the 50% at sort of 59 area. We've got the 50% of this downtrend, and then a little bit higher up we've got an interesting little trend line that's not so obvious, and that's why I like it. If we scroll back, effectively what you're looking at here is almost the last 4 or 5 years of data, and what we've kind of seen is that this little trend line has come in and has actually acted as a good resistance point for quite some time, and then it acted as support and then resistance again. And once we took it out back in the Scottish referendum last year, the market aggressively moved to the low side. So I would definitely, it's acted as a reaction point. It comes in around just before the 160 level, but I would definitely be looking at 159.85s to initiate shorts. Other than that, I do suggest people just stick with the trend. The trend is still firmly to the upside. So that's the pound against the dollar. Let's then move on to the euro against the dollar. Another good week for the euro against the dollar. Okay, we've continued to see this upside theme. We have spoken about the 113, so very crucially, don't forget that 113. It's acting support and resistance over the course of the week. What I would say in terms of this euro dollar, a lot like the oil price, where we have a low volume area, I would definitely say that this area between sort of 110 and 111 is a very low volume area. You can see it hasn't really traded between 110 and 11 for many years. So what I would say, once this market does start to turn and the sellers start to step in, okay, the most logical target where we should accept value is that 110.30 area. So keep an eye on that. It is starting to show a little bit of weakness. You can see we've tried numerous times to close above this 114, and the market's just not having any of it right now. It's almost battling up at these. Buyers are struggling to hold on to the higher prices. In terms of the weekly, however, okay, still a solid close for the week, still a very good close for the week, so nothing suggests you turn overly bearish just yet. In terms of the longer term trend, okay, we all know that the euro's been sold very aggressively since early last year. But very important is, in terms of a bounce, we're just at the 23.6 retracement point, so still a very shallow bounce in the euro. If it does start to turn, there are sufficient shorts waiting in the wings to just start shorting this market. So keep an eye on that euro. It's going to offer some fantastic points. It is looking to start running into a lot of sell side action, so keep an eye on this market. It is going to provide some good opportunities over the next few days. And then just to finish off, let's revisit the Canadian dollar. I spoke about this last week and said how we were talking about this nice strong uptrend in the market, and we were talking about how we could potentially get on this market. Now, two things I want to point out about the CAD at the moment is that, one, almost most of the major currencies are actually up against the dollar this week. Yet the Canadian dollar was almost flat at some point today. It's just showing a lack of wanting to be strong at the moment. The CAD, a little bit like the Japanese yen. It's struggling to make gains against the US dollar, whilst everything else is. So again, what I would say, we've got these legs here. These legs tell us a lot, guys. They really tell us the market's reluctance to hold lower prices. Now, that won't suddenly change. Something fundamentally would need to change that, where sellers commit to holding these lower prices. So right now, what I would say is, if the dollar turns, or if we get some more negative data out of the CAD, this market could very easily turn back around, and we could continue to build value inside this flag type structure. So right now, I would definitely be looking at that sort of weekly high. As you can see, we did fail to break last week's low and very quickly retrace. So keep an eye on the CAD. It is showing again, it's taking its time. It's not quite ready yet to get short the CAD against the dollar, but do keep an eye on that. And just to wrap up, I just want to finish off with what I think is important to me, and it's something I think all traders, a bit like Mike Bellafor, he always says, it's all about one good trade, and then another good trade. For me, it's pretty much, this summarizes it. It's not about the money, guys. This job's never about the money. Rather, it's about the process and execution. Now, you'll see a lot of the time, I'm always going to show you guys a lot of ideas, a lot of strategies, a lot of ways that you can make money, but at the end of the day, it doesn't matter whether you're wrong or right. What matters is that you have the correct process and that you execute it according to your plan. If you do that, okay, guys, you will make money in the long run. And then just to finish off, be patient, don't compromise yourself, and ensure you maximize your profits. Have a good week, and we'll catch up again next week.